Welcome to Option for All. Today's lesson is Position Sizing. Part 2, How to Manage Portfolio Risk. You've already learned how to size individual trades and adjust for volatility. Now we're going to look at the bigger picture, managing your entire portfolio so your risk stays balanced throughout the trading day. This is what separates professional traders from those who blow up their accounts. When you have multiple positions open at once, you're not just dealing with individual trades, you're dealing with overlap. Correlation matters. If you're long several tech stocks and you also add a bearish or neutral setup in the same theme, you're still doubling down on one sector. If tech suddenly reverses, all of those positions feel the impact together. That kind of concentration is dangerous. Instead, you want your intraday exposure to be smoother. Imagine you have $50,000 deployed during the session. Rather than stacking all your trades into one sector, you spread them out. Maybe you have some exposure in tech, some in financials, some in utilities, and some in index ETFs. When one area gets weak, the others help stabilize your P&L. Your curve becomes smoother, and your downside becomes easier to control. If your account is under $30,000 and you're trading cash only, this simple rotation, closing a position and replacing it with a different directional bias, is enough to manage risk. If your account is above $30,000 and you choose to use a margin account, you can also add defined risk spreads to fine-tune your exposure. Both approaches share the same goal: avoid letting one sector or theme control your entire session. Your broker's tools help with this. Most platforms show your overall delta and how much of your exposure is tied to a single direction. If you see that you're 70% bullish and concentrated in just a few trades, that's a red flag. You can fix it by trimming some bullish exposure and replacing it with a neutral or bearish setup, even on the same ticker, as long as you're not opening opposite positions at the same time. Options let you play both directions but never simultaneously. The key is to avoid being overloaded in one direction. Next, let's look at scaling your entries. Most traders go full size immediately. They calculate their risk, fire the whole position, and hope for the best. Professionals don't operate this way. They start with partial size and let the market confirm their idea. If the setup works, they add. If it fails, they cut early with only half their intended size at risk. This method improves your average entry and reduces emotional drawdowns. Scaling out is equally important. Instead of closing a position all at once, take profits in stages. Close part of the position at your first target, then manage the rest based on how the market behaves. With multi-leg trades like credit spreads or condors, you can close each leg individually as they hit profit levels. Scaling this way protects your gains, reduces exposure, and gives you more flexibility while the market is moving. Now let's talk about protecting yourself when a trade gets tight. Imagine you enter a QQQ trade and the market pushes toward your short strike. In a cash account, the safest move is to reduce size or close the position early. Take the manageable loss and free up capital. If you're using a margin account and defined risk strategies, you can reduce exposure by adding a small protective option to cap the worst-case outcome. Either approach serves the same purpose: reduce risk before the position becomes unmanageable. Before adding new trades, stress test your exposure. Ask yourself, if the market drops sharply in the next hour, what happens to my positions? If volatility spikes intraday, how will this affect my P&L? For margin traders, check how much margin your positions need during volatility. For cash account traders, focus on your acceptable intraday loss threshold. If the potential loss makes you uncomfortable, reduce size or flatten direction. The goal is to structure your risk so nothing surprises you. Here are the key points to remember. Monitor your overall portfolio delta and sector concentration using broker tools. Ladder entries and exits to improve pricing and manage risk actively. Convert undefined risk into defined risk when markets move against you. Stress test scenarios to ensure your account can handle realistic market swings. Thanks for joining today's lesson. If you're ready to elevate your trading expertise, join our Option for All community in school, where professionals connect, learn, and share advanced strategies. Enjoy live sessions and exclusive Q&A discussions to support your growth. Find the link in the bio and video caption. For even more insights and updates, follow Option 4, all on Instagram, YouTube, X, and Facebook. Your journey to expert trading continues here.